Big banks blowing out expectations this week thanks to major deals on Wall Street as third quarter earnings season kicks off. Bank of America seeing its profits surge with investment banking revenue jumping 43%. Joining me now, Merrill and Bank of America Private Bank CIO Chris Hyzy. Chris, great to see you again.
You too, Jack.
Thanks for walking down the street to see us. So not only Bank of America, but also your peers had really good earnings to start off this season. But you were already recommending financials. Good call. Why? What did you see there?
Well, we see the environment is attractive for the financial sector in general. It's a part of our what we call our combined trio, which is financials, industrials, and consumer discretionary. As the economy picks up a little bit more steam, despite what we're all seeing in headlines, we're actually starting to see some momentum there in the United States and a little softness here or there in Europe, but overall some acceleration on the GDP side. And then, of course, when you see some components and fruits popping up, green shoots, if you will, on the M&A cycle. And then finally, overall, when you're looking at diversified financials, including the asset managers, with the appreciation of wealth and the exposure that's going on across a lot of different asset classes, that gives us some very good comfort as it relates to a sector portfolio.
And maybe a tailwind from rates as well.
That's correct.
So let's talk about a hint, a sniff of potential bad news in the financial industry. Jamie Dimon's cockroach comment in relation to some small company bankruptcies. But the question is, could that be something systemic? What's your view there? Well,
I think it's really important to kind of step back a little bit whenever we see headlines like this and understand that as investment managers, strategists, portfolio managers, what have you, you want to make sure you focus on the trend lines, right? We all look at the headlines, but focus on the trend line. Trend line right now in default rates is very low. We're not even at the midpoint in the cycle here. We're still very early in the credit cycle, let alone a default cycle. So underwriting standards on individual type of credits, overall, we're going to read about. We're going to see quite a bit of this because that happens normally.
Okay.
We do not see this as a broad brush across the entire spectrum. In fact, we should actually see default rates over the next 12 months potentially go down versus up.
But you had already been pulling back a little bit from private credit in your recommendations to clients.
What we saw is an opportunity to actually take advantage of another opportunity within the private market space versus we don't feel the same way about private credit. We actually believe that you're still getting a good premium versus the public markets in private credit, particularly at the high quality side. But then when you start to see the opportunity set in things like secondaries and infrastructure investing, the data center build out, those are areas that have now been pushed a little bit higher in our spectrum.
Got it. I want to switch gears slightly. You mentioned infrastructure and data centers. Obviously, AI is where all the excitement is, but we're also hearing talk of, is there an AI bubble? What do you think?
Well, this is one of those, another headline. We see all the capex, right? The three components of the GDP, nominal GDP growth over the next few years, you have to put this consumer right in the center, like we usually do. Housing is not additive right now overall to the GDP equation, but the capex is, and we're seeing enormous capex boom. It's very early. Is it the first inning? Probably not. Is it the seventh? We don't think so. You want to call it fourth inning or something like that? The first wave of this, Jack, is not a bubble. The first wave is efficiency, productivity, and then we're seeing that flow through the economy. And we're now starting to see full democratization of AI. That'll happen over the next couple of years, and then you monetize it. So bubble is probably not the right word. Are we building it up? Yes. Now we're going to see the demand pull through.
This is the Merrill bull I hear talking right here. Speaking of that, you're overweight stocks in general, but specifically you also mentioned healthcare not doing so well, but it's been not doing so well for so long. You maybe see an opportunity?
Yeah, we've been watching the healthcare space for a while. Whenever you start to see the worries over the artificial intelligence boom start to slow down a little bit or enthusiasm around it, you start to see the more defensive sectors. And then all of a sudden, a big headline comes through, whether it's drug pricing or something like that. So the investment community is not willing to commit new dollars over and above what we've already seen to the healthcare segment, but they're attractively valued. It's a very disparate sector, though. You've got medical sciences, life sciences, medical technology, drugs, biotechs, et cetera. So you have to pick your spots in there, but they have been acting better
Okay, real quick, we're just about out of time, but long-term municipal bonds, that's interesting because everybody else is saying stay short.
Yeah, we pivot right to fixed income. Whenever you have the structural changes going on, particularly in muni land relative to treasuries, you have to take advantage of it. A lot of times that happens at the longer end of the curve. It's not suggesting that hold the bond for 30 years. It's like picking good credits that give you a good attractive yield relative to treasuries, and that's at the longer end of the curve.
That spread is higher than usual.
Exactly.
Alrighty, Chris Hyzy, thanks so much for coming by.
Thanks, Jack.